What strategies can you use when investing in multifamily real estate, and how do those strategies impact your risk as well as your returns? Well, in this video, I'm going to be walking you through the 4 strategies for investing in multifamily real estate. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about the 4 multifamily investing strategies. So I think how I'm going to lay out this video is we'll cover the 4 strategies here, and then we'll talk about risk and returns on this side and how everything comes together. So number 1, the first strategy we'll talk about is called the core strategy. Now, it's not an apple core. Even though you should eat an apple a day. No, when we're talking about the core strategy, we're talking about the core of the market. So this strategy entails purchasing a property, a building, in the heart, in the core, in the top area of that marketplace. The reason is there's always going to be a demand for great location. I know it's cliche, but in real estate we say location, 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 and it is so true, even though it's way overused, but it is the truth. So with the core strategy, it's seen as the least risky strategy, and there's a couple reasons why. So we'll draw our risk-o-meter. You know what? Let's even call it the risk-o-meter. And then we have the least risky, and then we have more risk over here. I should trademark the risk-o-meter. Okay, so with the core strategy, typically we're using less leverage. Less leverage. And what that really means is we have less debt on the property, and it's not atypical to see a core type of investment where they have sub 50% debt. So that means when we have 100% loan to value, less than half of the property's value is mortgaged or is leveraged. So this means you're going in with lots of cash, lots of equity, and you're basically buying the best, the top locations, buildings that have no work to be done. They're typically brand new AA, AAA types of properties, and you're just sitting on these gems in great locations, and the market over time is going to push and drive your values up because you are in a prestige building in a prestige location, and that is never going to change. So that is the core strategy. I should say low LTV as well. Okay, so strategy number 2, we have core plus. Now, what does the plus mean? Well, we're taking the core strategy where we're buying in great locations, great properties with almost no work in the core plus strategy. So in core, there's nothing to be done. These buildings are brand new, they are pristine, or they're totally renovated, and there's nothing to be done. There's no additional capital, CapEx, that has to be put into the building. With core plus, we have a little bit of work. As my son would say, just a little tiny bit. So we have a little bit of work, but we're still using lower LTVs. So not as low, not as cash intensive as the core strategy, because we're probably going to bump up our leverage a little bit because we have a little bit of touch-ups to do with core plus. But we're still buying great buildings in great locations, but we just have a little touch-up. So, maybe some exterior work, some lipstick stuff on the outside, maybe some lipstick on the inside. Nothing too drastic. We're not doing any heavy lifts or heavy renovations. We're basically buying a great property in a great location, and, we're just doing some light touch-ups. So the risk profile here on the risk-o-meter, it's still not very high because we're going in low leverage still, and we're not doing anything too crazy to the property that would upset anything. Plus, we are in prime locations. Now, maybe I should here. Let me extend the risk-o-meter, just so you guys don't get the wrong impression. Okay, there we go. So now we're about halfway here. Okay, or thereabouts halfway. So now we get into the bottom 2. So now we have number 3, which is value add. So I'm a big proponent of the value add investing strategy. So what value add, I've done other videos, and I'll put a link right up here to a video I did explaining everything there is about the value add strategy with the 2 components, physical and operational. Check out that video if you want to go more in depth. But with the value add strategy, we're actually looking to do some work, get our elbows dirty, whether it's doing interior renovations, adding amenities, even just changing out the operations, so the staff, the marketing, the brand branding of the property. We're trying to find ways to drive that NOI up. So it's a lot more active than the core strategy where we're just buying the property, low leverage, and sitting on it and waiting for that market to appreciate up because we're in such a great spot. With value add, we're looking for problems we can fix. And lots of properties have problems. Maybe it's been a long time owner and they haven't raised the rents. That's something we can fix. Maybe the current owner has let deferred maintenance creep up on them and there's a lot more work to be done and they don't have the capital to do it. We can come in, acquire the property, do the work, and then take advantage of the higher NOI and the new improved property look and really drive those rents up. So this is the value add strategy. Now, compared to core and core plus, it falls on this side of the riskometer because we're using higher leverage. So I'll call it higher LTV, loan to value ratio. Higher LTV, plus we're doing more work. So we're going to have units being turned, especially in multifamily. So as somebody moves out, we're going to go in and do all the renovations inside, and we may have some more vacancy during that renovation period, whether it's 18 months, 24 months, until we get all the work that we have to have done. What does that mean? Well, that means that their cash flow may be a little bit tighter during that renovation period, but by the time we get out of it, we have a much better product and it's done to our specifications. So that's why some people feel it goes a little bit higher on the riskometer. And then number 4 is called opportunistic. It's always hard writing at the very bottom of the whiteboard. Now, opportunistic, this is where you can look for, distressed sellers, distressed properties. You're going in really heavy lifts. And typically with opportunistic, you can see LTV, so leverage, 80%, 75%. You are using a whole lot of leverage because you're pumping in so much capital in to fix those properties. So compared with core, lots of cash, lots of equity, low debt. And then here on this side, we have high debt. Now, on the riskometer, this is the highest right here because there's more that can go wrong. Oftentimes, you're not cash flow positive when you're buying these distressed properties. We've seen ones where fire has ripped through the whole thing, or it's just been left and it's 30% occupied. You have crime issues. You have a whole bunch of tenant issues in there. That can cause a whole lot of issues, and do have challenges in terms of financing, and you have to use some other means rather than the core property where a whole bunch of lenders want to give you their money in the form of a mortgage because you are in a prime location and you have great tenants and all of that sort of stuff. So we have to, when we're looking at returns and how these strategies impact your returns, we have to take a look at risk. The lower the risk, the lower the returns you are expected to receive because you are going to be compensated by the market for putting your capital at more risk by higher return. We have our riskometer, but now let's get our returnometer going here. And our returnometer is going to be here. So we have less, higher. Now let me explain why this kind of works the way it does. Let's say you are an investor and you are going to be investing in an opportunistic type of deal. There's no cash flow, you have a lot of capital, you have a long project timeline. Lots of things can go wrong with these types of deals, right? Because you have lots of moving parts, you have lots of hiccups and all that sort of stuff. If you're an investor, are you going to accept the same return as a very stable core property? No, because there's a higher element of risk here. Your risk exposure is higher. Therefore, the market's going to reward you with a higher return on the returnometer. Now, on the flip side, with the core property, it's you can call this a safe because it's very low leverage. You're buying in a great location, great property, no work to be done. You're going to, as an investor, if you're worried about your risk exposure, you're going to accept a lower return on this in exchange for the lower risk. So it's all about exchanges of risk exposure and returns. My personal opinion is risk is okay because it gets you the higher return. So this is why I like the value add strategy. So check out that video I put up before. With the value add strategy, especially with multifamily, we can acquire cash flow producing properties from day one and then further improve them. So we're already acquiring cash flow producing properties. We're going in, doing renovations, finding the problems to fix, raising the rents, changing management, changing the advertising and branding, renovating the interiors, adding amenities, finding other value adds, so trash pickup, covered parking, private lawns, that sort of thing, storage even. We can do all these things to the property to boost up that NOI, and this is how commercial properties, multifamily properties are valued. I'll put a link right up here to a video I did explaining all about the income approach and how we value these properties. Every dollar of NOI we produce has a big impact on the valuation of our property. This is why I love the value add strategy. But investors love all sorts of strategies here. You can do core and very low risk, lower returns, but if you're an investor who's worried about that risk, perfect strategy for you. Core Plus, you have a little bit of lipstick stuff to be done. It's still lower risk, lower leverage there, but your returns. So it all depends on what you're looking for. Opportunistic, you win some, you lose some, but the potential return is there. Value add, I think that's, I know there's 4, but if I would say value add, if I could put that somewhere, I would put that straddling the middle. You're not in the least risky, you're not in the most risky. I would say it's a good middle line right there. Now, obviously, there's different types of value add. You can have some heavier lifts, some lighter lifts, and that's a whole different video for a whole different day. But hopefully this gives you an idea of the 4 investment strategies: core, core plus, value add, and opportunistic, and how they relate to the riskometer and the returnometer. I'll be trademarking those in the future. So if you did enjoy this video, definitely check out the free Facebook group right down below. A great group of people, and definitely check out the Multifamily Conference coming up May 14th and 15th, live in person. We've got Kevin O'Leary, Joe Fairless, Joel Block, a whole bunch of other speakers covering every single aspect. I've personally handpicked them, and it is going to be an insane, amazing, inspirational 2 days. So definitely join us, multifamilyconference.ca. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel. And until next time, happy investing.